as I said, I think we saw a lot of capital that was raised on mandates where there were no product for. I think everybody has gotten more realistic. Also the investors or pension funds behind all these mandates. So we are seeing new mandates of capital today that are much more tailored to the situations in specific countries. But again, it's from the investor's point of view, it's more a matter of absolute return, unfortunately, rather than risk-adjusted return. I'm still seeing that. And in the Nordics, for instance, it's very difficult to compete with pension funds that are happy with 5% return on an office investment. And it's difficult to see that these new types of debt mandates or debt investors, that they will take any huge market shares in our markets at least.
I think Morten is right that these, especially these local Scandinavian markets, it's always very difficult for foreign capital to compete, both because of the different return requirements, but also because of the perceived jurisdictional risks. We have assets in Norway, for example. It's not in the EU. They don't have the euro. Even it's an extremely strong and stable economy that might scare a group of investors away just by definition. But what we said before is that clearly there is much more capital than product at the moment, and I think that this goes across the whole continent and across most asset classes actually. Whether it's a new issuance of senior or mezzanine debt, or where they have origination problems, or whether it's the acquisition of loan portfolios, or whether it's the acquisition of prime or not as prime real estate.
In some ways, I mean, the fact that there's a perception values will rise could lead to more transactions or more situations being unravelled because there's a greater, more rational basis for equity to come into a deal or some sort of deal to be done. But on the other side, people who've held on this long may say, well, they want to hold on a bit longer to get access to the further increase in value. So sometimes the increase in value is difficult to predict, ignoring for the moment deleveraging and everything, how it will impact on particular situations.
You mentioned the search for yield, which has pushed a lot of rational purchasing decisions just because there's yield when there isn't in a lot of other conventional asset classes. The other point, we get an awful lot of sovereign wealth funds who are all desperate to invest in the UK and Europe. And a lot of them have hardly scratched the surface at the moment, but the Malaysian Federation, for instance, or whoever it is, there's loads of them want to come and invest in Europe, but they haven't really started, and they're not quite sure how they're going to go about it.
I just coming back to actually what you opened with, the Blackstone Mortgage Trust, $5 billion loan fund. I think that's a good example of capital that is being designed to intelligently fill a gap which is in the market. As I understand the product, it's extended senior, something like extended senior, which I think definitely will have a home somewhere in Europe. Again, it will be difficult to compete in the Nordics, but I think that is something where there is a gap in the market. Interestingly enough, observing from a Nordic perspective, it's exact same models that the German banks entered the Nordics market with 6, 7, 8, 10 years ago, which didn't pan out to be that successful for them. But I think that's not a matter of type of product, it's a matter of who your borrowers are.
And timing, yes.
Timing, perhaps.